Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner, owner of Elevation Financial on the web at elevationfinancial.com. If you'd like to find me, I'm also on pretty much all the socials, so feel free to reach out. That's where I am. So, are you a victim of recency bias? That's the question today. We're going to understand and overcome recency bias and its impact on your investments. So, I'll start off by just asking a question. Are you making investment decisions based on recent events? If so, you might be falling victim to recency bias. When it comes to investing, it's really easy to get caught up in the latest news and let it influence your investment choices. However, this cognitive bias can have real consequences for your investment performance. So, understanding recency bias is the first step to overcoming its impact on your investments. And by recognizing when and how this bias affects your decision making, you can make more informed and rational choices overall. So, let's explore the psychology behind recency bias, how it impacts your investments, and how to potentially overcome it. So, first of all, what is recency bias? Recency bias is a cognitive bias that affects our decision making process. It's a tendency to give more importance to recent events or information when making decisions. So, in other words, we tend to give more weight to the most recent information while ignoring older information. This bias is really common in the world of finance, where investors often make decisions based on the latest news or the latest market trends. So, recency bias is a mental shortcut that our brains use to simplify complex processes. However, it can lead to irrational investment decisions. So, for instance, if you hear about a company experiencing a temporary setback, you might be tempted to sell your shares of that company, even if the long term prospects are still solid. So, understanding recency bias is really the first step to overcoming its potentially negative impact on your investments. So, what is the impact of recency bias on investments? Let's take a look. Recency bias can be significant when it comes to impacting your investments. It can cause you to make investment decisions that are based on short term fluctuations rather than long term trends. And this can often lead to missed opportunities and really hurt your investment performance as well. So, for example, let's say you invest in a stock, a mutual fund, an ETF that's been performing well for several months or several years. However, the investment experiences a minor setback and its price drops. So, let's say that fund drops, the ETF, the stock, whatever it is, the price drops temporarily. If you have recency bias, you might be tempted to sell your shares based on the short term setback, even though the long term prospects are still strong. And this can result in missed opportunities for those future gains. Recency bias can also lead to overreacting to news events. For example, if the stock market experiences a sudden drop due to a global event such as pandemic, for example, investors might panic, they might sell their shares, and this can cause a further drop in prices and result in pretty significant losses. This behavior can and often does manifest through poor investment performance. So, in this example, um, there's a study or a data set that was published by JP Morgan, and it talks about the diversification versus the average investor. So, in this example, the market returns of the S&P 500 over the range of about 20 years was about 7.5%, about 7.5%. However, in that same time period, the average investor returns was just under 3%, actually 2.9% in this particular example. So the average person investing their money did, less than or half as better or half as good, less than half as good as the average market returns overall. Why is that? A lot of that is due to recency bias. It plays a large part in contributing to the poor returns experienced by the average investor. Things like, selling when the market's down, pulling out and going to cash when things are scary, when the news says something. They look at these recent events or recent trends and they make their decisions based on those recent trends. And that leads to poor investment performance because they're losing out on the long-term gains overall. So here's another example, an example of recency bias in investing, a more specific example. So imagine that a specific sector ETF, let's say a technology ETF, has been performing exceptionally well for the past year, significantly outperforming the broader market indices. So an investor will come, John, reads about the high returns and high recent returns specifically, and decides to invest a large portion of his savings into that ETF, expecting that the trend will continue. So John's decision is heavily influenced by recency bias. He's focused only on the ETF's recent performance and ignoring several important factors like historical performance, He's not considered how the ETF has performed across different market cycles. So if the ETF has a history of volatile performance, the recent uptick might not be sustainable. He's also not thinking about market conditions. He hasn't taken into account whether the recent performance is due to underlying economic conditions that might not persist in the future. He's also ignoring diversification. By investing heavily in a sector that's performed well recently, John might be inadequately diversified. That could increase his risk if that sector experiences a downturn. He's also ignoring valuation. If the assets in the ETF are now overvalued due to a recent run up, that could mean future returns could be lower as valuations return to their more sustainable levels. And really, he's performance chasing. It's a common outcome of recency bias where investors chase the performance of hot funds or hot sectors. Often that leads them to buy high and potentially selling low when the trend reverses. So in this example, recency bias could lead to poor investment decisions on the part of John in this case, because it causes the investor to ignore the broader, more comprehensive analysis that's necessary for a more well-informed investment strategy. So, if the technology sector were to experience a correction or downturn shortly after John's investment, he might, experience significant losses due to the lack of diversification because he made that decision based on recency bias. So how do you overcome recency bias in your decision making? How do you recognize and overcome it? So recognizing recency bias is especially important in investing, as we've talked about. It involves being aware of certain patterns of thought and behavior that might indicate you're overvaluing recent events. And here are some strategies to identify and recognize recency bias. First, your emotional response to recent events. If you find yourself feeling very bullish or very bearish based on latest market moves or news, ask yourself if the emotions are influencing your decision-making process more than the data and the long-term analysis. Also, you're focusing on short-term performance focus. Pay attention if you're overly focused on how an investment has performed in the last few weeks or months, instead of looking at a multi-year or full market cycle performance. Also, if you're chasing trends, notice if you're tempted to buy into investment, whether it's a particular stock, a sector, asset class, simply because it has recently seen a large surge in value. Also, if you're neglecting historical data, make sure you're not disregarding long-term historical trends and data in favor of recent developments. Maybe you're overconfident in the latest information. If you find yourself putting too much stock in the latest analyst report or economic data or news story without considering broader trends, it could be a sign of recency bias. Also, if you're ignoring base rates refer to the broader statistics or probability of an event happening based on a long-term data set. If you're ignoring these in favor of recent anecdotes or outcomes, that's a red flag. If you're forgetting about the mean reversion, the concept of mean reversion is the idea that returns eventually move back toward the mean or average. And if that's absent from your thinking, you might be experiencing recency bias. Also, just conversations and discussions. Pay attention to, who you're talking to about investments. Are you, only looking at recent successes and everyone in the media has an agenda, for example. So if you're looking at news stories that are, based on a specific agenda, if you're just looking at the event in isolation, you got to pay attention to the broader picture, the bigger discussion about investing. So how do we counteract recency bias? What are some things we can do? One is diversification. This helps to make sure that your investment decisions aren't overly influenced by recent trends in a single sector or a single asset class or a single investment or a single stock or a single fund. So you want to be diversified. That's very boring. It's not sexy. It's not exciting. It's not entertaining, but diversification is key to making sure that your investment decisions are reliable. Also, a systematic investment plan, sometimes called dollar cost averaging. Technically, it's not dollar cost averaging, but people use it interchangeably. So if you regularly invest a specific fixed amount, let's say every month or every week, it can really help you average out the cost of the investment and reduce the risk of making, poorly timed investment decisions based on recent market movement. So if you just have an autopilot investment plan, that's one of the best ways to avoid market timing and being prone to recency bias. Also, stick to your investment policy statement, or IPS for short. I've talked about investment policy statements before on this show, and I create them for all of my clients that I work with as well. An IPS should outline your investment goals, your strategies, your risk tolerance. And if you revisit this, that can remind you of your long-term objectives and help you keep recent events in perspective. Also, look for contrary evidence. Actively looking for information that contradicts your recent impressions or decisions can be useful. Making sure you're not just listening to an echo chamber of whatever the news is talking about in recent events. Also, I'm biased. I'll just say it. Work with a financial advisor. I try not to be too salesy or pushy here, but a financial advisor can help you provide or help give you more objective perspective, and that can help you to reduce that emotional interference that comes from recency bias. So recognizing recency bias really requires some mindfulness. It takes some discipline, and it's about questioning the reasons behind your investment choices and ensuring they align with a more well thought out strategy rather than the most recent headlines or the most recent market fluctuations. So I'm going to end with the most boring refrain ever. I'm sure you've heard it, which is stay the course. It's so boring. We're tired of hearing it. I get it, but that's what's important. So we want investing to be exciting, sexy, entertaining. We're always looking for that, but we love to glamorize investing as a game that we can win by outsmarting everyone else. But the reality is that investing, or rather I should say winning at investing, comes from following a disciplined strategy and staying focused over a long period of time. That's it. That's what winning at investing looks like. So don't let recency bias derail your investment plan. So stay self-aware and avoid these emotional traps that can hurt your investment performance. And that'll help you stay disciplined and focused on the long term. So with that, as always, I am happy to chat if you have follow-up questions about this anytime. You can reach out on my website. And that website, as you may know by now, is elevationfinancial.com. You can find me there. You can send me a note through my website, or you can book a complimentary money session if you want to go deeper, ask me some questions, get some feedback, maybe even think about working with me, or find me on social media anywhere, and I'm pretty easy to find. So with that, thanks for joining me today. As always, have a great day. We'll see you next time.